This screencast is going to cover inventory costing. As you know from your reading, the main type of system that we use these days with computerized systems is the perpetual inventory system. And what that means is that we keep track of our inventory perpetually after each transaction. In the past, where computers weren't as readily available, we used the periodic method, which means we just did a physical inventory every so often and adjusted our books. It's not nearly as accurate as perpetual system, and now with even small accounting systems being very reasonably priced and having inventory functions, most businesses use the perpetual inventory system. So that's what we're going to focus on. You'll see in your appendices that there is some information on the periodic system. We're not going to cover that in this accounting principles class. Okay, so with that in mind, I thought it would be helpful to review the inventory costing methods and focus on one of the methods that is the most difficult, I think, as far as calculations go. So let's just briefly discuss the four types of methods you'll see in this chapter. The first is called specific identification. And specific identification means that we specifically identify each individual inventory item. Um, and what that means is that you can solve for either cost of goods sold or ending inventory if you know two of the three things in this equation that we're looking at. Cost of goods available for sale is cost of goods sold plus ending inventory. So what you will see oftentimes in specific identification, you'll be told the specific items is sold. And you can calculate basically this item cost this much, and that was the cost of sale. So you generally will use this formula at some point to figure out either your cost of goods sold or your ending inventory for specific identification. An example I often use in class for specific identification would be large custom built items such as Boeing would use specific identification to identify their airplanes because each one would have different unique items on them and cost different amounts of money. So they would probably use specific identification for their inventory costing system. Okay. The second method I've got listed here is FIFO, and that stands for first in, first out. And an example I like to use for that, think of the dairy case at the grocery store. When you go to buy some milk or another dairy related item, the store is going to put the oldest items in the front so that they get purchased and they minimize spoilage. If you're like me, you'll sometimes dig around behind those items and try to get something that has a little newer date on it. So it'll last a little longer in your refrigerator. But the whole idea of the first item in is the first one sold is the FIFO method. So I think using kind of the dairy case to remind you of how that works may be helpful. LIFO is exactly the opposite, last in, first out. So what LIFO does, and again, these are all accounting costing systems. They may or may not correspond to how the actual physical flow is at the business. Okay, I'll give you an example after we discuss LIFO. So LIFO is last in, first out. So from a cost accounting standpoint, we actually are selling the newest item in gets sold first. Okay, and you're like, that's kind of counterintuitive. And from a spoilage standpoint, that's absolutely the case. But again, this is how we account for the cost. It may not mimic the physical flow of the items. So an example I like to give for LIFO is end of the model year at a car dealer. So the car dealer's got some item or some cars left from the previous year and they're not selling very quickly. And we have a new model year and new models come in and there are people that just have to have the newest car. So what'll happen is the prior year models will sit on the car lot and the new ones that came in, there will be people lining up to buy those. That's an example of LIFO as far as how it works in the real world. As I mentioned, sometimes the physical flow doesn't correspond to what the accounting flow is. Grocery stores are a good example. They are a big user of LIFO from a cost accounting standpoint. But you can imagine that that wouldn't be a good idea at all for a grocery store to actually use LIFO in their stores, particularly in their produce section or their dairy case. They would have a lot of spoilage. So they can use one cost or one accounting method and actually have the physical flows, how the items actually flow in their store can be different. Okay, and I think grocery stores are a good example because they do use LIFO from an accounting standpoint quite a lot. Okay, so those are the first three. The last method is called weighted average. And weighted average requires more calculations. That's the one I'm going to go through a detailed example of. And it the costs end up somewhere between FIFO and LIFO for weighted average. So it's kind of like an average method, kind of like what it sounds like. So with that said, I'd like to work through an example just so you can see how weighted average works. So what I've done here, and I recommend setting up a table like I've done here for a lot of your inventory costing. It'll keep everything straight and allow you to easily follow your work and keep your calculations accurate. Okay, so we started the month with 2 units that cost $350 a piece, and I've got those listed over here on the inventory on hand section of the schedule. On August 5th, we purchased 4 units that cost $360. Okay, and one thing you'll notice on this chart is all we have listed is cost. That's what we're all about, is calculating cost. If you see problems that list sales price, the only time that that is relevant is when you're preparing an income statement. So we don't care about sales price when we're computing cost. All we care about is what the inventory costs. So that's all that you see on this table. And that's all you should have listed on the tables that you prepare. Okay, so back to our problem. We've got these 4 items at $360. We extend the cost to $1440. I'm then going to transfer this over to my inventory on hand column so I can figure out what I have so far. I've got 6 units. The total cost for those 6 units is $2,140. Okay. Then I come down to the 15th and I sell 4 units. So what I'm going to have to do, I'm going to have to, at this point, figure out an average cost per unit so that I can apply it here to cost of goods sold. So the way I do that on a weighted average standpoint is I take the 6 units and I divide that into the 2140 of total cost. I come up with an average cost of $356.67, and I recommend you stay at least 2 decimal places. If you round off to whole dollars too soon, you'll end up with some errors due to rounding. So keep at least those 2 decimal places. Okay, so what happens is all 6 of these units now get mushed into, that is the cost for each unit, $356.67. The identity of these goes away. Okay, we now have 6 units at $356.67. So we apply that unit cost to these 4 units that we sold. So our cost of goods sold for this sale is $1426.68. Okay, I had 6, I sell 4, I have 2 left. So my inventory on hand at this point is 2 times $356.67 at $713.34. Okay, and that's what I have moving forward. I come down to the 26th, I bought 12 more units at $380 for a total of $45.60. I bring that over here to the inventory on hand, and I can now add that together. I now have 14 units on hand, and my total cost is $52.73.34. It's the total of the $713.34 and the $45.60. Okay, and then down here on the 31st, I sell 10 units. So I have to come over here, and I'm going to wait till I have a sale to calculate this weighted average cost. $52.73.34 divided by 14 gives me an average cost for these 14 units of $376.67. I can then apply that to my cost of goods sold to figure out my cost of goods sold for that transaction. And then I also have the information to figure out what I have left at the end of the month. 14 units minus 10 gives me 4 left. I'm going to use my average cost per unit to come up with inventory at $1506.68. So I get here to the end of the month. I had $6,000 in purchases. Okay. I had cost of goods sold for the month of $5193.38. That's the total of the cost of goods sold on the 15th and the 31st. And then over here for my inventory on hand, it's going to be what I have on hand at the end of the month. All right. A good way to double check your work to make sure that you've accounted for everything properly is to keep in mind that cost of goods available for sale is cost of goods sold plus ending inventory. Okay. And our cost of goods sold available for sale is going to be your beginning inventory plus your purchases. So everything you had available to sell during that time period. Okay, so we had our 6,000, but we need to make sure that we add in the $700 that we started with. So cost of goods available for sale is $6,700, and I can take my cost of goods sold of $51.93.38 and my inventory on hand at the end of the month $1506.68, and the sum of those equals $6,700. So what that tells me is that I've accounted for all of my inventory costs. I hope this has been helpful. I'll see you soon.